Good afternoon, good evening, or good morning, depending on what part of the world you're in. My name is Zach George. I'm the co-founder and chief investment officer of Startupbootcamp, one of the largest accelerators for early stage tech ventures on the continent, and a partner at a leading Pan-African seed fund. On my panel, we've got three very distinguished partners at VC funds across the continent: Stephen, Grin, Dhanyal, Davidson, and Agbaje. I'm going to ask each of them to do brief introductions on themselves and their funds, and then we'll kick right into it. So I'm going to start with Kofo, if you wouldn't mind going first.
Yes, name is Kofoworola Agbaje. I work for a firm, Quona Capital. We invest globally in fintechs, and I'm based in Lagos, Nigeria.
Fantastic. Dhanyal?
Thanks, Zach. Joining from Cape Town, my name is Dhanyal Davidson. I work for Goodwell Investments. It's an impact investment firm focused largely on fintech, agri, mobility, logistics, and energy.
Great. Last but not least, Stephen.
Hey everyone, I'm joining from New York, co-founder, managing partner of Lateral Capital. We are a $50 million fund focused from seed to growth, Pan-African, with 16 companies currently in the portfolio, and a focus largely around digital infrastructure and enterprise technologies.
Great. Thanks, everyone. Right. Seeing as this is the last panel of the day, of the last day of the conference, I want to bring it back to the common denominator here, which is how can technology leapfrog investments, and how do different funds ranging from seed funds to Series A to growth stage funds and borderline early stage private equity funds, how do they use technology to scale their respective portfolio companies? I'm gonna start off with Dhanyal here. So Goodwell has historically had a focus on the financial sector, starting with remittances, with lending, with financial inclusion, something that 7 or 8 years ago would have almost no tech involved in it, right? That has changed completely in the last 3 to 4 years, with technology underpinning every aspect of financial inclusion, from lending to savings to remittances to even down to digital invoicing and collections. How have you seen this within your existing portfolio and in the decision-making process as a fund manager at Goodwell?
Sure. So specifically in the fintech space, we see the use of sort of what we would call more advanced tech to be a significant competitive advantage. And when we speak about that, we speak a lot about looking at and understanding within a portfolio company about AI and machine learning. Where does that fit into their operations? Where does big data fit in? And increasingly security. I would say that previously there wasn't much of a focus on security and thinking about how firms were scaling and building around that. But as we're seeing companies get much bigger, moving Pan-African, even moving outside of the continent, security is becoming a much bigger topic of the conversation, and we're seeing a lot of technology focused around security specifically.
Got it. Kofoworola, from your perspective, I mean, Quona has been doing. Quona has made quite a name for itself in the fintech space, obviously with its roots in DC, with Axion, and now the work you're doing across the world. Your focus is on emerging markets, Asia, Latin America, Africa, financial services, fintech. Again, similar question. Because the financial services opportunity in emerging markets, but Africa specifically, is driven to a large extent by consumers. A large portion of the population is unbanked, does not have access to credit, does not have formal insurance. How easy or how difficult are you finding it as Quona to introduce the idea, the need for consumers to be more tech savvy, and how does it affect your portfolio making process?
So from a consumer perspective, I think COVID has, if anything, shown people the need to go digital, and at first, especially with lockdown in most places, has forced consumers to rethink the need for face-to-face, be it with buying something online or going to the bank. But for us specifically, I think what tech has been able to do, especially as we look at opportunities globally, is to change our lens of investments. Because I can't remember who made this quote, but there's this quote that any company can become fintech, and I think that's what tech does. So even across the Quona portfolio, we've invested in ag companies because they're able to offer financial services. We've invested in logistic companies because they've been able to offer fintech. So I think we're at a point whereby consumers are now increasingly moving towards being more digital and more tech savvy. And as a result, tech offers the opportunity to now broaden the distribution channel, because even non-tech companies or companies that might not be seen as financial services providers normally are now able to offer financial services.
Yeah. Anything specifically on the lending side that you wanted to add there, Kofo?
Yeah. So it's also kind of going in the same line, because you're able to solve a challenging problem for a consumer. So we'll pick logistics, for example, because you're able to either move parcel from A to B for an SME, or you're able to move a consumer from A to B. You get this transaction history that actually allows you to underwrite them in a different way. And we've seen that model being used in Asian countries, and now seeing it increasingly in Africa. So it also might be an SME tool. You're helping them with inventory management, expense, etc., but are able to onboard lending because you now have transaction history, details of the sole director, whatever it is, and you have more details on the business or the consumer based on their day-to-day interaction with your app, and are able to earn that lending and actually underwrite the consumers in some cases better than most banks can.
Yeah. Thanks, Kofo. Stephen, I've known Lateral Capital for a while. You guys are an incredible firm. Sitting in New York with part of your team on the continent, part of them in the US, how are you compare and contrasting tech in the early stage African VC environment versus what's out there in the US right now, having the opportunity to sort of put one foot in both continents? What are some of the trends that you're seeing from a tech adoption at this early stage of the investment process?
Yeah, it's a great question. And we spent a lot of time thinking about this, in particular, as we think about the next fund as well. And I think our job as GPs and fiduciaries of capital are also to adapt and to question our own assumptions, and sort of the assumptions that went into baking the cake for Fund 1 in 2017, 2018 versus 2020, 21 and beyond is you can't ignore COVID. This was not just an epidemiological event. It was really a catalyst for taking things that were perhaps at the margins and making them mainstream. I think, something like e-commerce is the most obvious example, where we've seen e-commerce penetration go from 15% to 30%. You look at companies like Mercado Libre in LATAM and how they've grown in the last 6 months. Jumia has sort of deepened and strengthened sort of its areas where around e-commerce where it had good traction. We've seen those numbers increase over Q3. I think for us, thinking about that future, we need to think about sort of the waves of growth across the continent. So that first wave for us was driven by B2B and enterprise. We need to think a lot more structurally around the B2C and really where the consumer opportunities will lie across the continent. And obviously there'll be different pockets of prosperity there. But in some, this crisis, I think, is a catalyst. We've seen that certainly around our asset light portfolio, where some of our companies are growing 50% month over month. Others are obviously impacted and impaired by COVID. And I think all of that sort of just shapes a lens that how we come out of this as a species and as organizations focusing on technology, we have to think differently about the future than we did about the past.
Yeah, no, it's absolutely true. I mean, I've noticed even in our own portfolio at Startupbootcamp and my angel portfolio that just if anything, the crisis has hastened the process of founders digitizing their offerings by at least 6 months to 12 months, if not longer. So things that they had, product launches that they had planned for 2 years from now are now being done a year before, because they just cannot afford to wait that long. A question for sort of everyone on the panel around IP. Now, corporate Africa has taken a long time to start working with startups, and we know very well, as someone mentioned earlier, B2B business models on the continent have a much higher chance of succeeding than B2C business models for a host of reasons, but the most important one being just the cost of acquiring customers in the information economy we have in Africa is a lot harder. So, translating a B2C model to a B2B2C model requires the B in the middle, which is the bank, the insurer, the telco, the retailer, to come to the party. Now, in a lot of cases, these corporates, and we've struggled with them a lot the last 3 years, need to own the asset and to own the IP. So in your discussions, when you look at investing in companies that have a B2B business model, that are relying on enterprise SaaS, subscription models from corporates, license agreements from corporates, how have your discussions progressed with corporates that are the end consumers of technology that these startups are creating? Has that been a sore discussion point? Has it affected your investment making process in startups? Whoever wants to take that first.
I'm happy to start. I think one, from a founder's perspective, nothing is more humbling than having a corporate want to be a investor in your company. And we've seen that across our portfolio, where a number of sort of flagship banks in East Africa and West Africa have actually taken small minority venture type positions in companies. I think it's important to make sure good governance in place to avoid exclusivity and those types of arrangements to obviously protect IP. I think what we've experienced, and particularly more in South Africa, I think, than in West or East Africa, is that corporates are very open to taking small minority interests in these companies to learn. And I think of that as almost an optionality on the future for those businesses. It's not necessarily that so-and-so's fintech will put GT Bank out of business, but so-and-so's business perhaps will provide a product that will provide tremendous value and efficiency and operational gain for GT Bank or other. I think that conversation from 3 years ago to today has changed fundamentally. I think most corporates see that now. Yeah.
Now we've definitely seen that in corporates, and I mean it's probably a little harder for banks versus other non-bank systems because of capital adequacy ratios or Basel II requirements from an accounting perspective. But I've seen a lot of corporates on the continent be open to that than, let's say, a couple of years ago. So Dhanyal, go ahead, Kofo. Yep.
I'll add on to what you've both said on corporates are definitely waking up, especially on the distribution end, and also with the kind of medium scale corporates, because what they don't, most of them anyway, would as much as possible want to reduce their customer acquisition cost. So if you have a fintech or a new player in the market that's able to offer them a new customer base whereby they don't have to go and acquire the customers. But if, for example, I know a lot of fintechs in Nigeria use one of the banks as kind of their deposit bank because they don't want to go and actually go to customers, have salesperson on the ground to acquire. And because they're doing that, the small or medium scale businesses are starting, then the larger ones are waking up. So even GT Bank recently said they wanted to be a fintech and they would have a fintech division within the bank. So there is definitely a gradual change in the landscape of wanting to partner with fintechs. And I think that with time would also affect how the IP ownership, because they know they can't move, or most of them do know that they can't move as fast as these fintechs can. And when we look at startups in the space, what we want to know is how do the B players, how do they see you? Do they see you as a partner, as an enabler? Do they see you as a competition? And that would also help for us to know later on, or 2-3 years down the line, how would these big players see the startups we're investing in?
Got it. Yep. Anything to add, Dhanyal, from your standpoint?
Maybe just to add to what Kofa was saying about some of the themes we're seeing with corporate engagement, there's a lot of activity around aggregation. And I think that if we look ahead for what we might see as a theme is there's still a big absence of infrastructure on the continent and the rails, which sort of power some spaces. And players who are aggregating now the sort of fragmented system on the continent. You know, you think about a player like MFS Africa, where they're trying to aggregate all mobile wallets on the continent, so you can send money to wherever that might be, and you now become a one-stop shop for a corporate looking to enable remittances or money transfer across the continent. I think the sort of aggregation on the continent is going to become a bigger theme, and players who are in the space of aggregation and giving corporates a one-stop shop to enter a specific space, that's a space in technology that's quite interesting going forward.
Got it. And just to touch upon briefly on the IP issue, it's been a thorny issue for me personally and for the funds that I worked at. How important is it for entrepreneurs to own the IP that they have without the risk of signing exclusivity contracts for a year? I mean, I've seen a lot of entrepreneurs that have gone through accelerators and they have a POC or a pilot or a closed beta with the bank or an insurer, where the bank releases customer data in a closed sandbox and experiments are done. And then a year later or a year and a half later, before a product launch goes live, they said, oh, hold on a minute, you used our customer data for your test, therefore we own part of this IP. And have any of the three of you been privy to those situations in your portfolio companies, or have you seen that play out going forward? Because almost everything we touch and feel will have a tech component to it. How do we deal with that going forward as an industry, with corporates looking to also own any sort of IP they can justify themselves?
Those games have been going on for forever. That's not just unique to sort of Africa's ecosystem. I think standardization around documentation is incredibly important. When we come in early to a seed company, let's say they're building some sort of SaaS solution, making sure that the SLAs, the service license agreements, are sort of internationally compliant. I would say that sort of IP, investing in IP lawyers to patent protect, whether it's source code or something, is more of a Series A type investment than it is sort of at the earlier stages. And the early stages, really, it's about protecting that through clear delineation of, this is mine, this is yours, I'm using yours to benefit both of us. And piggybacking off your data, for example, from Dhanyal's example, to build a better model, for example, for lending. And I think a lot of that just gets covered in service contracts, license agreements.
Got it. Okay, let's move on to something a bit more exciting. Dhanyal, I'd like to start with you. So tell us about one or two of the most interesting pieces of technology you've seen outside of the fintech space. You said Goodwell's moved into transport, logistics, ag, something that really excited you or caught your mind, especially over the last 9 months in the midst of COVID. You don't have to share exact names, but just that the concept of technology, we'd be keen to hear about it. And the same question to our other two panelists.
I'm only going to speak about one, and the second one I would have spoken about is SparkMeter, and I'm hoping that Stephen will maybe speak about SparkMeter because they are also an investor alongside us over there. But the one I'll speak to is a company called Good Nature Agro, sitting in Zambia. We invested into the company recently, and they've got a model of growing legumes, but through smallholder farmers across Zambia. And of course, you can imagine sitting with in excess of 10,000 farmers, the complication of monitoring your smallholder farmers becomes increasingly complex, especially when you're providing them with some of the inputs and then also helping them with access to market for their outputs. And so some of the interesting technology we've seen around that is just enabling communication between smallholder farmers and sort of the intermediate layer being your extension agents, and then your final layer being your company in Good Nature Agro. But seeing how they've been able to aggregate data across the smallholder body, and then also implement targeted interventions where there might be areas of concern or problems that they're seeing across the smallholder body. So that's been really interesting. If we sort of fast forward and look, what might happen in a couple of years and focusing on the smallholder space, a lot of the investments or the tech we see in ag now is quite advanced and quite expensive. If you think about drones, if you think about remote imaging, it's not really that accessible to a smallholder farmer. And so hopefully these things become cheaper over time, as with most technology. And we can start bringing that into the smallholder space within impact as well, and seeing how that can further improve smallholder monitoring, access to inputs, and then access to market.
Great, fantastic. There's a similar company, obviously, in South Africa, aerobotics on the agri side that has a fantastic piece of technology that helps reduce loan losses from a imaging and sensing perspective, and that data gets reported back to field officers, and that directly goes out to loan officers on the banking side. Kofo, any standout pieces of tech that you've seen in this past year that have made you just go up and say, whoa, we need to take a deeper look at that?
So generally, we have seen more of the embedded finance theme, which I've mentioned a bit earlier on non-traditional finance companies being able to offer financial services. But another piece of tech that we've seen this year is in insurance, which is to most people a very boring sector, and a sector that hasn't quite seen the level of disruption that most sort of sectors have. And a couple of startups in this space are now trying to help the current stakeholders. So trying as much as possible to offer sort of a marketplace that helps both underwriters that have the ability to underwrite any kind of insurance, and the non-traditional distribution parties that have a large customer base. So you're either providing, for example, selling mobile phones and you want to insure that mobile phone, or you're selling home appliances and you'd like to insure it to your customer, but you don't have the ability to underwrite, or you do have this big or large customer base that you're hoping to provide additional service to. And we've seen tech that are able to help those two different parties, one, talk to each other, but also digitize their whole process. So you can go from you're buying a mobile phone, but you can also get insurance because the distribution partner has been able to embed insurance into it. So that's a growing sector, and especially with the pandemic, I think there would be an increase in not just insurtech plays, but also non-traditional companies starting to offer insurance products.
Very, very true. Thank you. Stephen, any standout technologies you want to talk about?
Yeah, I think the role for APIs, especially in financial services in Africa, is incredibly exciting. Sort of for the benefit of perhaps people who are listening who don't understand what application programming interfaces are. I think the best analogy we've heard is if you think about sort of oil fields needing to be connected through pipelines and refineries, and you think about banks as sort of those oil fields, those APIs are what interconnect everything. And the type of aggregation of that data, what can be done with that data, the ability for fintechs to piggyback on that old infrastructure is all done through that. So we're quite excited about sort of how open APIs are coming across in banking and telcos and what that will do for the next wave of innovation. And I think the other thing that we're incredibly bullish on is decentralized finance. I think we're finally at a point where sort of layer 1, layer 2 architecture for blockchain and Ethereum-based solutions will have a meaningful impact, especially in the fintech space. I know a lot of sort of interest has largely been around crypto in Africa and exchanges and, obviously ways to protect people's savings and wealth and for trading. But I think sort of the next wave of architecture is coming. We're seeing some really interesting companies form, in particular in North Africa. And so we're very bullish on that.
Got it. Amazing. Dhanyal, you wanted to add something from your side?
Yeah, one of the things we've been seeing more in the conservation space, but that I think actually has uses outside of just conservation, is this concept of TinyML. And to briefly explain what it is, if you on your phone say, hey Siri or hey Alexa or hey okay Google, I'm not sure what you Android people say, but that's actually happening on your phone through this concept of TinyML, and your little unit within your phone is actually picking that up. And so what we've seen is that there's been deployments of these small units in the conservation space, monitoring things like rhinos moving into poaching zones. Similarly with elephants, they do it in some wind farms to monitor if wind farms have stopped moving, so that they can then have interventions for those specific units. And I think what this can do is move outside of your conservation space and into some other sectors where people are trying to monitor something very specific and then take an action based on that monitoring. And so it'll be interesting to see how applications of this move outside of the conservation space into other sectors.
Yeah, I mean, I think the application of machine learning and AI are slowly but surely infiltrating to industries we never thought would benefit from it. I mean, conservation is one of them. Property tech. I mean, prop tech wasn't even a word in Africa 2 years ago, and now there are at least 20 prop tech companies that use AI for everything from virtual tours to maintenance and repair to rental agent acquisition. It's quite crazy. I think the common thing here is there's data is the new oil, data is the new water, whatever you want to call it. But anyone that is able to process a vast amount of data into a synthesizable, cohesive way that can be understood and used by an end user, be it a business or a consumer, will win in the long term. I mean, that's why data scientists are some of the most expensive people on the market today. So, there is no denying that technology is going to play a huge factor in what enterprises get funding. And it is my honest belief that the process for analyzing how good a piece of technology is moving earlier and earlier to pre-seed and seed funds in addition to just the A and B round. So back in the day, an A and a B or a Series C focused fund would have a detailed tech diligence. Now that's happening at the seed and pre-seed stage as well. And that just shows how key technology is to our industry in Africa. We've come to the end of our panel. Were there any other burning sort of questions that any one of our panelists wanted to cover before we hand off? Anything?
I would just say, despite the macro, it's been a really good year for tech in Africa. I'm sure my colleagues here, the sort of velocity of deals, great founders forming new companies, the M&A activity, obviously, big wins with Paystack. It's been a fantastic year. The tailwind of COVID has been quite strong, building on the momentum of 2019, and we're incredibly excited about the future.
Fantastic. Yep. Okay.
Zach, I think there was one or two questions from the audience. It's in the
I can see it now.
Notes there. Would you like
sure.
To
yeah.
use your last minute?
Yeah. There's a question here around the ease of replication of technology into neighboring regional countries, and the success that ventures have had. Any thoughts on that? On scaling tech beyond borders? I've got some thoughts on that, but any one of our panelists want to add their 30 seconds worth?
Yeah, I think a lot of companies have a Pan-African goal, and that's probably one of the easiest way to not only replicate technology, but also replicate best practices and success. And you would see, especially because there are regions in Africa where you have either similar regulations. So an example would be if a company is in Nigeria, they immediately think, can I start this in Ghana? And if you're in Ivory Coast, for example, you're thinking about all the Francophone countries.
Correct.
Similar division with East Africa. If you're in Kenya, you're thinking, can I expand to Uganda? Can I expand to Tanzania? So I think there's a regional focus or Pan-African goal, and that's an easy way for replication of both tech, but also best practices in startups and VC.
Yeah, I mean, scaling across borders in Africa is not easy if you're at the B2C stage. But I will say that in the portfolio of companies that at least I've seen, it is a lot easier to scale your tech provided you have a license agreement with a large corporate at the holding company level. So if you're working, let's say, in the social commerce space and you're reliant on MTN or Vodacom as your partner, having an agreement with the parent company in Johannesburg makes it a lot easier for you to launch into different markets. Now, as a founder, you've got to think, am I willing to share revenue and give up margin in exchange for volume? And that's the $1 million question that a lot of founders sometimes stay away from. The smart founders say, hey, I'll take a smaller pie, a smaller fraction of the pie to have a larger pie. And it is actually very easy to scale tech across the continent if you work with large conglomerates. And most banking, insurance, and telco conglomerates have presence or presences in more than 10 African countries.